Welcome to Celebrity Investing, your go-to source for insights, tips, and updates on navigating the exciting landscape of personal and global finance. Please like, share, and subscribe for more exclusive content. This is part 1 of understanding the Sharpe Ratio, key to smart investing. Ever wonder how to measure the risk and reward of your investments? Look no further than the Sharpe Ratio. This key financial metric helps investors understand the relationship between the potential return of an investment and its level of risk. Whether you're new to investing or have years of experience, knowing how to use the Sharpe Ratio can significantly impact your portfolio's success. In this video, we'll break down what the Sharpe Ratio is, why it's important, and how you can calculate it to make more informed investment decisions. By the end, you'll not only grasp the concept but also learn how to apply it to maximize your returns while managing risk effectively. Let's dive in and make your investments smarter. Understanding the Sharpe Ratio. Investors often come across the term Sharpe Ratio when evaluating investment opportunities. This ratio plays a crucial role in assessing the potential risks and returns associated with a particular investment. Let's dive into a comprehensive understanding of the Sharpe Ratio, its components, and how to interpret its values effectively. Definition of Sharpe Ratio. The Sharpe Ratio, developed by Nobel laureate William F. Sharpe, is a measure used to calculate the risk-adjusted return of an investment. It helps investors understand the return they receive for the amount of risk taken. In simpler terms, the Sharpe Ratio indicates whether the returns of an investment justify the risk involved. Components of the Sharpe Ratio. Risk-free rate. The Sharpe Ratio incorporates the risk-free rate, typically the return on a treasury bill. By subtracting the risk-free rate from the investment's return, the ratio accounts for the additional return earned for shouldering risk. Standard deviation. Standard deviation measures the volatility or risk associated with an investment. A higher standard deviation implies greater price fluctuations, indicating a riskier investment. The Sharpe Ratio considers this volatility in relation to the investment's return to assess risk-adjusted performance. Interpreting Sharpe Ratio values. Analyzing the Sharpe Ratio values can provide valuable insights into an investment's risk-return profile. A higher Sharpe Ratio indicates better risk-adjusted returns, signifying that the investment has performed well relative to its risk level. Conversely, a lower ratio suggests lower returns for the amount of risk taken. By understanding these components and interpreting Sharpe Ratio values, investors can make informed decisions regarding the risk and return characteristics of their investments. It serves as a useful tool to evaluate the performance of various investment opportunities and compare them based on risk-adjusted returns. Calculating and using Sharpe Ratio. When it comes to assessing the performance of your investments, understanding the Sharpe Ratio can be a game changer. This metric helps you evaluate the risk-adjusted return of an investment and determine if the potential return is worth the risk taken. Let's delve into how you can calculate and utilize the Sharpe Ratio effectively. Formula for Sharpe Ratio. The Sharpe Ratio formula is straightforward but provides valuable insights into your investment's performance. It is calculated by subtracting the risk-free rate of return from the investment return and then dividing the result by the investment standard deviation. The formula is as follows: Sharpe Ratio equals return of portfolio risk-free rate. Standard deviation of portfolio. Practical calculation example. Let's embark on a step-by-step calculation scenario to grasp the concept better. Suppose you have an investment portfolio that returned 10% in a year, and the risk-free rate is 3%. If the standard deviation of your portfolio is 15%, you can calculate the Sharpe Ratio using the formula mentioned above. Subtract the risk-free rate from the portfolio return. 10% 3% equals 7%. Divide the result by the standard deviation. 7%, 15% equals 0.47. In this hypothetical scenario, the Sharpe Ratio for your portfolio would be 0.47. Comparing investments using Sharpe Ratio. The Sharpe Ratio acts as a compass in the world of investments, allowing you to compare different investment options on equal footing. By looking at the Sharpe Ratios of various investments, you can evaluate not only the returns they offer but also the level of risk taken to achieve those returns. This comparison helps you make informed decisions based on a comprehensive view of risk and reward. In essence, the Sharpe Ratio serves as a powerful tool to assess whether an investment's returns adequately compensate for the risk undertaken. It enables you to cut through the noise of pure returns and consider the risk factor, providing a more holistic approach to investment evaluation. By leveraging the Sharpe Ratio, you can navigate the fast-paced world of investments with a clearer perspective on risk-adjusted returns. Significance of Sharpe ratio in investment decisions. When it comes to making sound investment decisions, the Sharpe ratio plays a crucial role in evaluating the potential returns against the risks involved. Let's explore how this metric impacts investment strategies. The Sharpe ratio is a vital tool for investors seeking to understand and manage the risk-return profile of their investments. Developed by Nobel laureate William F. Sharpe, this ratio helps investors evaluate the performance of an investment by adjusting for its risk. It is particularly useful for comparing different investments or portfolios, helping investors make informed decisions that align with their risk tolerance and investment goals. At its core, the Sharpe ratio measures the excess return of an investment over the risk-free rate, per unit of risk. The risk-free rate typically represents the return on a virtually risk-free investment, such as U.S. Treasury bills. The formula for calculating the Sharpe ratio is simple. Subtract the risk-free rate from the investment's return, and then divide this excess return by the investment standard deviation. The standard deviation serves as a proxy for the investment's risk, capturing the variability of its returns. A higher Sharpe ratio indicates that the investment has provided better returns for each unit of risk taken. Conversely, a lower Sharpe ratio suggests that the investment's returns have not adequately compensated for its risk. For example, an investment with a Sharpe ratio of 1.5 is generally considered to have a good risk-adjusted return, while a ratio below the 1st of May signals that the investment is not providing sufficient return for its risk level. Understanding the Sharpe ratio is crucial for portfolio management. Investors can use it to compare the performance of various assets, helping them to construct a diversified portfolio that maximizes returns while minimizing risk. By focusing on risk-adjusted returns rather than just absolute returns, investors can better understand the true performance of their investments. This approach is particularly important in volatile markets, where high returns may come with significant risk. The Sharpe ratio also plays a significant role in modern portfolio theory, MPT. According to MPT, an optimal portfolio is one that offers the highest expected return for a given level of risk. The Sharpe ratio helps identify such portfolios by measuring how well an investment compensates for its risk. In practice, investors use the Sharpe ratio to select a combination of assets that maximizes their portfolio's risk-adjusted return, often referred to as the efficient frontier. However, while the Sharpe ratio is a powerful tool, it has limitations that investors should consider. One limitation is that it relies on historical data to calculate standard deviation and returns, which may not always predict future performance accurately. Past volatility does not guarantee future volatility, and relying solely on historical data can be misleading. Another limitation is the assumption that investment returns are normally distributed. In reality, returns can be skewed or exhibit fat tails, meaning that extreme events are more likely than a normal distribution would suggest. This can lead to an underestimation of risk, especially for investments with non-normal return distributions, such as options or certain hedge funds. Furthermore, the Sharpe ratio does not differentiate between upside and downside volatility. Investors are typically more concerned with downside risk, the potential for loss, rather than overall volatility. Alternative measures like the Sortino ratio address this by focusing only on downside deviation, providing a more accurate picture of risk-adjusted performance for risk-averse investors. To mitigate these limitations, investors should use the Sharpe ratio in conjunction with other metrics and qualitative factors. Combining the Sharpe ratio with measures such as the Sortino ratio, alpha, and beta can provide a more comprehensive view of an investment's performance and risk profile. Additionally, qualitative factors such as economic conditions, industry trends, and company fundamentals should also be considered to make well-rounded investment decisions. Another practical application of the Sharpe ratio is in performance evaluation. Fund managers and investors use it to assess how well a portfolio or investment has performed relative to its risk. By comparing the Sharpe ratios of different funds or investment strategies, investors can identify those that have delivered superior risk-adjusted returns. This is particularly useful for evaluating active managers, who aim to outperform the market through skillful investment decisions. Moreover, the Sharpe ratio can guide rebalancing decisions. As market conditions change, the risk-return profile of a portfolio may shift, leading to a deviation from the desired level of risk. By regularly calculating and monitoring the Sharpe ratio, investors can identify when a portfolio has become too risky or too conservative and make adjustments to bring it back in line with their risk tolerance and investment objectives. In conclusion, the Sharpe ratio is a key tool for smart investing, offering valuable insights into the risk-adjusted performance of investments. By understanding and applying this ratio, investors can make more informed decisions, construct optimized portfolios, and effectively manage risk. While it is important to be aware of its limitations, the Sharpe ratio remains an essential component of a comprehensive investment strategy, helping investors achieve their financial goals with greater confidence and precision. Stay tuned for part 2 and continue to watch our videos to gain valuable insights into the world of finance. Subscribe, like, and share to continue your journey to financial success.